Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone. Good morning. What a fascinating Friday it is. We've got quite a stack of financial headlines here. They paint a really dynamic picture across the global economy. We're seeing surprising economic growth here in the U.S., sort of challenging assumptions and their political shifts impacting markets abroad, and, well, some truly unexpected twists in the world of crypto and consumer finance. It's a lot to navigate.
Absolutely. And our mission today is really to cut through all that noise, deliver those critical insights you need. We've pulled the important nuggets of knowledge from sources like Barron's, MarketWatch, Bloomberg, and the Wall Street Journal. So by the end of this deep dive, you'll get a clear, concise understanding of what's really driving the markets this Friday, August 29th, 2025. Think of it as your shortcut to being incredibly well-informed.
Okay, let's truly unpack this then. We're going to dive deep into the latest signals from the U.S. economy and the Federal Reserve. We'll explore the surprising performances and sometimes, underperformances of major corporations. We'll venture into the ever-evolving crypto landscape and then broaden our view to significant global developments, things that could impact your portfolio, maybe even your everyday wallet. It's quite the journey, so let's get started. Kicking things off with the very pulse of the U.S. economy, we're seeing some, truly interesting signals highlighted by a surprising upgrade to our gross domestic product. It seems the economy is showing more resilience than maybe many expected.
Indeed, and this is a significant piece of news. Both the Wall Street Journal and Bloomberg are reporting it. The U.S. economy grew at a faster clip than initially estimated in the second quarter. The inflation-adjusted annual rate, it's now at 3.3%. That's a notable bump up from the prior estimate of 3%.
Wow, 3.3%.
Yeah. This isn't just a slight adjustment. It points to some surprising underlying economic strength. Jim Baird, he's the chief investment officer at Plante Moran Financial Advisors, he put it simply, said this new data put a little more polish on the quarter.
A little more polish. I like that. It underscores that unexpected robustness. But here's where it gets really interesting, particularly concerning the Federal Reserve. We're right on the cusp of some critical inflation data today, the Personal Consumption Expenditures, or PCE index. What exactly are economists watching for with this number? And how might it, dramatically influence the Fed's highly anticipated future rate cuts?
You've hit on the crucial point there. MarketWatch highlights that the core PCE index, which is, the Fed's absolute preferred inflation barometer, it's forecast to rise by 0.3% in July.
Okay.
Now, while we're starting to see some higher inflation filtering through the economy, partly from new tariffs maybe, Fed Governor Christopher Waller has actually just backed a series of interest rate cuts starting as early as September.
Starting in September, already.
That's what he's backed, yes, with potentially more cuts following over the next 3 to 6 months. However, and this is a big however, if this PCE reading comes in unexpectedly high today, that could truly temper those hopes. It could significantly limit the scope for any future cuts, maybe force the Fed to rethink its dovish pivot. It puts them in a fascinating, difficult position.
It really sounds like the Fed is walking a very fine line, balancing that economic strength, inflation concerns, market expectations. And this also brings us to another critical issue that's been, dominating headlines: the ongoing saga surrounding the Federal Reserve's independence. President Trump's actions, his comments, they're certainly adding a new layer of complexity to this already delicate situation.
They absolutely are. And look, this isn't just a political squabble. It has real financial implications. MarketWatch, Bloomberg, the Wall Street Journal, they're all covering it. Federal Reserve Governor Lisa Cook suing President Trump.
Right, trying to block him firing her.
Exactly, over allegations of mortgage fraud. This has truly opened a new chapter in the showdown over the Fed's independence. Trump's openly looking to reshape the central bank. We're seeing this play out in various ways. White House Council of Economic Advisors head Stephen Miran. He might fill a short-term vacancy soon. And you've got Vice Chair for Supervision Michelle Bowman and Governor Christopher Waller already dissenting, favoring rate cuts at the last meeting.
So the pressure's building internally, too.
Definitely. And what's fascinating here, according to Bloomberg, is the dollar. It's actually set to weaken beyond August, specifically because of these rate cut expectations and the ongoing Trump-Fed fight. Some strategists are noting this chips away at the USD's safe haven status.
That's a powerful phrase.
Yeah.
Chips away the USD safe haven status.
Yeah.
For our listeners, what does losing that safe haven status actually mean? What are the broader consequences beyond just, currency fluctuations?
That's an excellent question. It's something every investor should consider, really. Losing safe haven status for the dollar isn't just about the currency's value, like in your pocket when you travel. It signals a fundamental shift, a shift in global investor confidence in the stability, the impartiality of the U.S. financial system.
Hmm.
If the world's reserve currency is perceived as, well, politically compromised, it could make it more expensive for the U.S. government to borrow on international markets. That potentially impacts our own national debt, maybe even the stability of global trade. It introduces a layer of political risk that traditionally hasn't really been associated with the U.S. dollar, which is why Christian Hoffman, he's head of fixed income at Thornburg Investment Management. He warns the unintended consequences and longer-term impact of Fed meddling are likely to be more significant than any short-term actions.
Right. So while equity markets might initially shrug this off, that foundational stability of the dollar is a key long-term concern. Okay, from these broader economic currents and the Fed's challenges, let's zoom in. Let's look at how these forces are shaping corporate America. The tech sector, especially, has been under the microscope, particularly with NVIDIA, the world's most valuable company, having just reported earnings. Expectations were, well, sky high. They even drove the S&P 500 to new records.
That's right. The Wall Street Journal reported that investor expectations for, quote, blowout results from NVIDIA were so intense, they actually lifted the S&P 500 to its 19th record close of the year on Wednesday, and then its 20th record on Thursday.
Wow.
The market was practically holding its breath. However, when NVIDIA's record sales finally came in...
While they were impressive, yeah,
Yeah.
they were largely in line with estimates.
Just in line, not blowing them away. Not blowing them away, and crucially, its future projections were seen as underwhelming, at least underwhelming, after several previous blockbuster quarters. This led the stock to pare its early losses, but it still closed down 0.8%. And Bloomberg noted that tech stocks generally dropped on Friday, that risk-off trade ahead of today's PCE data we mentioned. NVIDIA fell another 1.2% in pre-market trading today.
So it seems even the AI darlings aren't immune to the gravity of market expectations. The narrative seems to be shifting, maybe, from anything AI is gold to a more scrutinizing view. Marvell Technology, another chip company, also seems to be facing similar challenges. Is this indicating a broader trend, do you think?
I think it could be, absolutely. This isn't just an isolated NVIDIA incident. According to MarketWatch, Marvell's stock fell significantly after hours on Thursday, continued to drop into Friday. Why? Because its earnings didn't just fail to top expectations, but its guidance didn't offer any upside either. Yeah. Despite reporting record revenue $2 billion, largely driven by AI demand, the company simply struggled to live up to that intense AI hype, and its shares were already down 30% year-to-date before this report. So this latest news just added to the pressure.
Right.
And reinforcing this trend, Bloomberg reported Dell Technologies also slumped more than 6% after reporting slower sales of its AI servers. It really suggests that while AI is transformative, yeah, the market is beginning to demand more than just potential. It wants solid, consistent, exceeding performance. And that's proving harder to deliver across the board. The narrative might be shifting from, limitless growth to maybe a more sustainable but perhaps less explosive trajectory for some of these companies.
That's a key insight, the market's evolving expectations for AI. Okay, but let's shift gears. From the cutting edge of tech to some more traditional giants, specifically AT&T. They just made a huge $23 billion acquisition. How might this impact its dividend? That's often a major draw for investors, right?
Right, and this is a fascinating strategic move that Barron's picked up on. AT&T spent a hefty $23 billion, yes, to acquire about 50 megahertz of crucial low and mid-band spectrum from EchoStar. Now, normally, for income investors, a massive capital outlay like that usually signals a potential threat to the dividend.
Yeah, you'd think so.
But in this case, the acquisition could actually make AT&T's dividends safer.
Safer. How?
Because spectrum is a finite, essential resource for wireless services. By securing it, AT&T is kind of future-proofing its core business. Citi analyst Michael Rollins, he views this positively for the long-term trading multiples for AT&T, Verizon, T-Mobile, because it strategically keeps this valuable spectrum out of the hands of any potential new competitor.
Oh, okay. Defensive move, too.
Exactly. And AT&T maintained its financial guidance, expects to earn $2.02 a share in 2025, continues its $20 billion share repurchase plan. Rollins even has a $32 price target, suggesting a 14% total return, including its 3.9% dividend yield. So it's a bold move, sure, but one that could pay off for long-term shareholders.
So a surprising move that actually strengthens its core business. Okay, now let's move to a different segment of financial services, one that reflects current economic realities for many consumers. First Cash, the pawn shop giant. They're making some really big moves globally.
Yeah, this story from Barron's offers a powerful insight into the current consumer landscape. First Cash, already the largest pawn store operator in the U.S. and Mexico, over 300 locations, is now expanding its pawn shop empire into Europe. They're acquiring H&T Group, the largest pawnbroker in the UK.
Into Europe, wow.
Right, and this isn't just geographic expansion, it's a strategic move that's, quote, meaningfully accretive to earnings. What's truly telling here is that in an era of, well, tightening bank lending, stubbornly high interest rates, financial pressure on households, pawn loans are increasingly becoming a crucial lifeline for many. First Cash is skillfully capitalizing on this growing demand. Their second quarter results were strong. Pawn loan balances climbed an impressive 13% year over year. And their American First Finance, or AFF, segment that offers buy now, pay later options that also continues to perform exceptionally well, contributes over 20% of their pre-tax income. It really underscores how alternative financial services are thriving when traditional credit becomes less accessible.
That's a stark reminder of the economic pressures impacting everyday people. And speaking of buy now, pay later, another big player in that space, Affirm, is making headlines too, but for a very different reason.
Indeed. MarketWatch recently announced that Affirm Holdings, Inc. actually swung to a profit in the fiscal fourth quarter. That's a significant turnaround for them.
A profit? Really?
Yeah. Its revenue jumped over 30% to $876 million, easily surpassing expectations. This surge was primarily driven by people, quote, flocking to its buy now, pay later offers and 0% interest loans, caused its shares to rally nearly 17% after hours. It's another data point suggesting consumers are actively seeking flexible payment solutions in this higher interest rate environment. Affirm's clearly capturing that demand.
It's fascinating how different companies are thriving by addressing these various financial needs in challenging times. But let's look at a truly surprising contender in the retail space,
Yep.
Dillard's. This old-school retailer has an almost unique approach, and it's yielding incredible results.
Oh, this Dillard story, highlighted by MarketWatch, is actually one of my favorite counterintuitive insights from this week's headlines. It's great. While many retailers struggle, Dillard's stock has outperformed even Nvidia's over the past 5 years, soaring over 1,800%.
1,800%.
Dillard's. And the kicker. The company has this highly unconventional choice to not hold earnings calls or provide much commentary. They almost deliberately avoid the spotlight.
That's bizarre.
Isn't it? Its success is attributed to a very disciplined approach, returning cash to shareholders and demonstrating strong, consistent operational prowess. It really makes you question the conventional wisdom of market communication. Shows that sometimes just quietly executing well, focusing on shareholder value, can yield extraordinary results, even for an old-school player.
That truly makes you pause and consider what really drives value. Okay, moving from the traditional to the truly unconventional, the crypto world, always buzzing.
Yeah.
This week, no exception, we're seeing a significant shift in momentum between Bitcoin and other cryptocurrencies.
Yeah, the crypto landscape is certainly never dull. Barron's reports Bitcoin was gaining 1.3% over 24 hours to reach $113,099 early Thursday. It's visibly reasserting its dominance over the sector, currently outpacing Ethereum and other altcoins like XRP and Solana. Bitcoin's dominance, its market cap share, had actually fallen from over 65% in late June down to 58%. But now it's bouncing off recent lows of around $110,000. Part of this resurgence, interestingly enough, is being attributed to President Trump pushing for lower interest rates, which, as we discussed, often make riskier assets like digital currencies more attractive to investors seeking higher returns.
So, political rhetoric influencing crypto prices, a very modern dynamic indeed. However, not everyone in the crypto space is riding this wave with ease. Michael Saylor's Strategy Inc., once seen as a bellwether for institutional Bitcoin adoption, seems to be facing a significant market backlash.
What's truly fascinating here, as revealed by Bloomberg, is just how quickly sentiment can turn in this space. Michael Saylor's once celebrated Bitcoin experiment at Strategy Inc., formerly MicroStrategy, is indeed facing a market backlash. The company, which really became a proxy for Bitcoin sentiment, saw its shares fall 15% this month alone.
15%.
Yeah. Its recent preferred stock offering, which was intended for Bitcoin purchases, drew kind of tepid demand. And the company has, surprisingly, returned to common share issuance despite earlier pledges to limit dilution.
Uh-oh. Investors wouldn't like that.
Exactly. It has clearly rattled investors, raising questions about the sustainability of that whole corporate treasury model Saylor pioneered. The decline of its premium over its Bitcoin holdings suggests the market is scrutinizing these strategies much more closely now.
That's a crucial development for anyone following institutional adoption of crypto.
Yeah.
But beyond market sentiment, President Trump, he's making waves not just by influencing the Fed and crypto prices, but by taking a highly significant step, putting government data, specifically GDP data, directly onto the blockchain. This seems like a massive shift.
This absolutely is a massive shift. It's a story Bloomberg brought to light that has, well, profound implications. The U.S. government, under the Trump administration, has begun distributing gross domestic product data on public blockchains. Bitcoin, Ethereum, Solana.
GDP data on Bitcoin,
Yeah.
seriously.
Seriously. This move, spearheaded by Commerce Secretary Howard Lutnick, it's far more than just a technical experiment. It's being seen as a U.S. government seal of approval on blockchain technology itself. It's part of Trump's broader effort to endorse the crypto industry, reflecting his remarkable shift from being a skeptic to becoming what some are calling a crypto president.
Right.
This lends an unprecedented level of legitimacy of trust to blockchain, suggesting it's not just for digital currencies, but for secure, transparent data management. We even saw Eric Trump call China a hell of a power in digital assets, despite its 2021 ban advising people to, quote, buy right now, close your eyes, hold it long term, do not get rid of it.
Wow.
This kind of enthusiasm, or at least this shift in perspective for blockchain tech from the highest levels of government, could truly accelerate its mainstream adoption across industries.
That's a truly significant development, potentially reshaping how we view data integrity, government transparency. Amazing. Okay, shifting our gaze globally now, we have some interesting movements in European bond and stock markets, showing a complex interplay of politics and economics over there.
Yeah, the European markets are certainly providing a good example of how quickly political events can impact investor sentiment. Bloomberg reports that dip buyers are already returning to French bonds. That's after yields surged following Prime Minister François Bayrou's surprise call for a confidence vote.
Already bouncing back.
Seems so. Despite the political uncertainty, Amundi SA, Europe's biggest asset manager, actually sees compelling opportunities in French stocks. They argue the political risk is now, quote, fully reflected in relative valuations. It's a classic contrarian play.
Interesting.
Meanwhile, in the UK, Bloomberg notes that lofty UK bond yields are paradoxically luring buyers, despite what some are calling doom-mongers. Big-name investors like Ned Group Investments are actually overweighting UK bonds.
Overweighting.
They argue these yields, which are near a 30-year high, are explained not just by fiscal concerns, but by surprising UK economic strength and the Bank of England's determined effort to combat inflation, which, demands higher returns. It shows that even in politically uncertain times, a deeper dive can reveal underlying opportunities.
That nuanced view of the UK market is insightful. Okay, now let's talk oil. We've seen a lot of volatility in commodity markets recently. What's happening on the oil front?
Oil is certainly telling a story of shifting dynamics this week. Bloomberg reports that crude